IS 36, impairment of assets, is kind of an interesting one, where a company's market capitalization is lower than the carrying value of the net assets. Investors will benefit from a disclosure that explains the shortfall and why the carrying value of net assets is supported. We had a question from the audience about that. We've discussed it, and here it is, really sitting in the OSC's guidance up to companies. They're looking for this kind of stuff to come creeping into your financial statements. So disclosure again, kind of paramount, and of course documentation on your decision, paramount. Critical judgments and significant estimates and uncertainties. Erez mentioned this one earlier on. I'll just quickly go through once again. Judgments are the result of being principles-based. When you have a choice, an application has to be made. There is no right line test. You're just making a decision. Going concern or functional currency, and so you may want to actually put out how, to the reader some disclosure on how you reached it. Estimates relate to an asset, liability, a revenue, or an expense. And an example of that is a measurement item. It's allowance for doubtful accounts, decommissioning liabilities. Put in your assumptions, talk about it a little bit. How did you get there? Focus on the big items, don't sweat the little stuff. They're not interested in seeing that, neither is your reader. And they want non-boilerplate disclosure. So it's about you, the company, not just some generic wording. I'll quickly go through reverse takeover transactions. Again, complex transactions. I mentioned you may have to document up quite well for those. We're seeing a lot of RTOs. It occurs when the shareholders of a target acquisition company, the legal acquiree, obtain control of the legal acquirer. So as a public company, you may be wanting to acquire a private company, but you're willing to give up 70% of your shares. In giving up 70% of your shares, it really is the private company ultimately that now controls everything, and they're deemed to be the acquirer. Those are going to be the financial statements coming forward, not that of the public company. You would assess if the transaction constitutes an asset acquisition, a capital transaction, or a business combination, and Erez alluded to that. Asset acquisition would be not buying a business or buying a company that does not constitute a business, doesn't have those inputs, processes, and outputs. Capital transactions might be a shell company that you're acquiring that has a public listing, and really what you're doing is acquiring a public listing. It's a quick way to go public. And the last one is a business combination, and separate rules for that. Determining an accounting treatment where the purchase price exceeds the fair value of the net assets acquired depends on the above. You might get a bump in assets, you might get an expense to the income statement for a cost of going public, or you might have goodwill. Look to IFRS 2 for the acquisitions and capital transactions, and IFRS 3 for the business. And the only guidance I think you're going to find out there for RTOs is likely in IFRS 3. It's pretty much akin. You can use those kind of rules for the asset acquisition and capital transactions. Clearly, with complex stuff, this is I would always be suggesting when you're going into a transaction like this, talk with your auditors, give us a call, let us know, and we'll talk through some of this. What's the most other considerations? What's the most reliable measure of the fair value of the consideration provided? What's the measure of the assets and liabilities themselves that are being acquired? Tangible and intangible. Don't forget that you might have favorable contracts in there that actually might have a value. So you can't just stop at what's on the balance sheet. Sometimes the company's got an agreement where they've got special rights. And what is the acquisition date? Always a great question. It's the date that you exercised your power, got control of the company. I think that pretty much concludes our discussion today. That kind of finishes up. This is our little cave at home on a same bad hair day. Just finishes it off a little bit. Go out there and say trick or treat. Watch your driving going home, all that stuff, because there's going to be little ones on the road. At this point, I would ask if there's any questions from the crowd. I think we have from our audience or clients. If there are any questions, there's some cards that were sent around that could be collected. Or just put up a hand and ask a question, or alternatively, I think the bars are open outside. So.
Yeah. There's one more thing. Actually, there's one more thing. Well, let's see if there are any questions first. Anybody want to ask anything? In particular, feel free. Don't be shy. We like questions because we learn from you just as much as we want to give you. If you don't want to ask it now, you can always contact us. Anybody? Anything? No questions? Everything's clear? Everything's clear for the next year?
We're that good?
All right. Okay, so one more thing. So we do have a couple prizes that we're going to give out, and I'm going to let the Davidson Angels walk you through that.
We just wanted to thank everyone for coming. Thank you, Guy and Erez, for enlightening everyone on IFRS. We appreciate you guys being here. We do have a couple prizes. I know that everyone was really shy to sit in the first couple rows, and now that I think about it, I should have only awarded the prizes for those people. I'm kidding. So if you look under your chair, you may have something tied or taped underneath. There's some antique chairs. Look all around you too. Okay. The only stipulation is you have to wear the mask and come up to claim your prize.
Let's see if there's anything in the front there.
Let them come on up, don't be shy.
Yeah. Erez, you don't qualify your staff.
Whoever comes up first gets first dibs on prizes, and I do have a bottle of Grey Goose up here.
Okay, we're doing this.
I saw one.
I didn't hear it. There we go. All right, way to go.
Okay.
That's okay.
We've got an umbrella, pad folio, gym bag, or the bottle of Grey Goose.
I've already got 5 Davidson umbrellas.
Attaboy.
So you want the
Love
Grey
the
Goose?
Grey Goose.
Yeah, there you go.
Well done, Steve.
Come on, don't be shy.
I know there's 2 more out there. There we go. So what do you not have? The umbrella, portfolio, or gym bag? Gym bag? There you go. That's all right. Carry on.
All right.
And portfolio or gym bag? Or umbrella?
Umbrellas I have a bunch.
Okay.
Portfolio it is.
Should we stop sending them out? Okay.
Great.
Thank you, guys.
You stick around for a drink, a couple hours, have a beer with us or something else. Chat with us, say hello.
Thanks for attending,
Thanks,
everyone.
guys.
Thank you.
I guess so, yeah.
Guy.
Question for you. Sure. How are you? Because it seems simple to me, but I should ask. So, property payments, because I'm director on various companies, so we have a property. We spend a couple $100,000 on it. You come along with your company and you want to, not a joint venture, but you just, I'm trying to think, I'm forgetting the term. Not lease it, but you want to explore it. And so you can earn a 55%, usually it's quite like 55%, and then you can get up to 70%. So you make a payment to us up front. So we've already spent $200,000, let's say, on it. And then you come and give us, say, 25 toward it, some shares, whatever, so 10,000. So you got 35,000 we've got back. I assume, under IFRS, I just reduced my 200,000 by 35,000 that I got back from it.
That's right.
Okay.
Now, if you gave up half of it, okay, for example, then you have to look at whether or not, well, if you gave up half for 35, does that mean the thing is worth 70? Or do you need to write something down? That's a second consideration.
Sure it is. Okay, no, and the ones normally you don't give up, he gives you money, you give me money for it, plus you have to, say, spend $1 million over, 3 years, let's say, then you can have your 55%. So you've gone and spent your money on it, now you have half of our property, you know, you have 55%, so I've only got 45% of that, so you're right. At that point, my property, I'd have to ask, is it only worth 90,000?
So that's the second consideration. But yes, if you do get the 30, you reduce your mineral property. That's step one, and then you got to look to see if there is something else there.
And then what you would do at that point is, why is the participant, if he's now got his 55%, he spent the money, well, he could still have his 55% and then say, we don't want to go any further with it, we don't think the property's worth much, but they still got their 55%. We actually have that with one of our companies.
Yeah.
So if he doesn't want to go any further, that gives you some indication that you might have too much on your books at that point.
It could, yeah.
Yeah, okay. So then he comes back at this point, he gets his 55%, and that is another one. He has 55%, and then it goes to a JV at that point where he has, say, 55%, and you've only got 45. Then, what do you do at that point with it? Okay, then you go with JV, you would go to equity accounting. Is that right? I'm right on that.
Exactly. In your initial one, you just reclassify from mineral property to equity, right? It's just like a reclass. But then you have to do equity accounting going forward, right? So on it, when you first determine it's a joint venture and it's equity accounting, you just take mineral property and you reclassify it to equity.
Investment in property.
Investment, whatever you call it.
Okay.
Right? Equity investment. You know, the terminology you can choose.
Okay.
Right?
So you do that. So now, what are you saying? Then you go forward, and we have to contribute $45 of every $100 that goes into it. So that just keeps getting added to your equity investment.
And that becomes an advance, right? An advance, as opposed to an expenditure on your property. So it's like beginning balance, advances, right?
Okay.
And then your 45% of the losses of that equity company. So your pro rata share of the net loss or income of that company.
And okay, but if you go to